Hi, welcome to the Capital Region Skinny from the Greater Capital Association of Realtors, where we dig into the most recent numbers from our market. Let's jump right in. As far as the numbers go, we're still playing on an uneven field with uniquely strong activity from last year's tax credit and fairly slow activity since the end of this year's tax credit. Newspapers warn of possible foreclosure moratoria, job growth is just barely in the black ink, and the midterm election cycle brought new leadership to Washington. Buyers are still armed with access to cheap loans and strong negotiating power. Recovery continues to crawl forward nationally. Locally, pending sales were down 28.3% from last October to arrive at 568 contracts written. Because of the effect of the 2009 tax credit, 2008 can serve as a better baseline. Since then, there was only 6.6% less purchase activity this October than there was in October 2008. Inventory levels were up a slight 6.1% as the number of active listings for sale grew to 8,374 units. Again, since 2008, inventory has only climbed 0.5%. Continue to keep an eye on this metric as it demonstrates the balance between the two most dominant forces in the marketplace, supply and demand. Prices posted an astonishing 13.7% gain, which speaks to the strength of the Albany market. The October median sales price of $199,000 was nearly $25,000 higher than last year at this time. In the face of diminished buyer activity, that's a major win. It could also simply mean that, of the people buying homes, more tended to cluster in higher price brackets. Negotiations continue to favor buyers as the percent of original list price received at sale checked in at 92.2%, which was a 1.2% dip since last year. Private companies are slowly hiring, and seasonally adjusted jobless claims are roughly on par with late 2008 levels. Our recovery is moving slowly, but at least it's moving forward. Consumer spending was also up in the third quarter. The latest GDP growth figures, everyone's favorite light reading, show an inflation-adjusted 2% third quarter growth rate, which barely beat the 1.7% growth rate for the second quarter. We need 2.5% to 3% growth to affect unemployment. We're close, but we're not quite there. Stronger economic growth will drive new household formations and instill the confidence needed for current homeowners to move up and for current renters to consider ownership. That's the Capital Region Skinny for this month. Tune in next month for the latest.